I want to start by first talking about many of you have heard of a hard market, and we are in this hard market right now. So I know we have some other insurance professionals on our call with us today, but this is probably an education for some of you that are not in the insurance industry. And I'm going to start with where we were 18 to 24 months ago. And what we would have said was, what I would have said and did say a year and a half, 2 years ago, was for every dollar of claims, an insurance company wants at least $2 a premium. And that's the fundamental premise of insurance, way oversimplified. So why does that dollar in claims for $2 a premium, why do insurance companies want that? Well, if we look here in the middle, that's a $1 claims for $2 a premium is a 50% ratio. And if we break that down to how insurance companies spend their money, ideally, for every dollar they pay out 50 cents in claims, their overhead, the cost of their insurance, underwriters, paying rent and electricity, their overhead is 35%. When you take that 35 and 50, that's 85%. That's called a combined ratio, and there's 15 cents left for profit. And that ideally is how the insurance company model works. However, before COVID hit us, we started seeing two things come into effect. The biggest of which was the insurance industry is calling it social inflation. So you may or may not have heard that term. What does social inflation mean? Social inflation means that over the past 24 or 36 months, the industry has seen a significant rise in the dollar amount that claims get paid out for. So historically, if it was a slip and fall and it would have been a $20,000 or $30,000 payout, those slip and falls are now starting to get paid out at $50,000 or $100,000. And even more so on larger catastrophic claims, where claims would be settled for $1 million and $2 million. Many of us have seen in the media, you can see it on the news, some of these claims now are getting paid out for $25 and $50 million. So the rise in social inflation and the opening up of the Child Victims Act for some old historical unaccounted for abuse claims started to increase the ratio of claims to premium collected. So this was early in 19, we started to see a breakdown in this insurance model. Our overhead remained at 35%, give or take for most companies, but claims started to creep up. Now, so the reality has changed even further since then. So we had, now this really kicked in the fourth quarter of 2019. That's when the hard market started. And then COVID kind of really increased the rate of insurance company losses. So what we're seeing is insurance carriers' reinsurance their reinsurance rates have gone up. So first, let's notice overhead was at 35%. And this is across the industry, we've seen carriers' overhead increase nearly 20%. And a lot of that's due to their reinsurance costs. Now, why is reinsurance going up? Reinsurance is going up because you had some major COVID claims that came from tremendous corporations like the Disneys or the airlines or further the cruise ships. They had business income losses that got sent to reinsurers. Reinsurers then started charging more across the industry. That created an increase in overhead. Then in the actual claim payouts, we saw some COVID claims being paid. We saw more Child Victims Act claims. We saw large catastrophic property losses with wildfires, with floods, and we have this tremendous increase in claims. So when we get to this 135% combined ratio, which is where we see claims at 94 and overhead at 41, and carriers are collecting $1, but paying out $1.35 in claims, we see a reaction from the insurance industry. So what do they need to do? What cost $1 before, all of a sudden they need to charge $1.50 for to try to regain the same 15% profit. And once you do that, where we were charging $1 of claims is $2 a premium, that now becomes $1 of claims is $3 a premium. or underwriting loss ratios were at targeting 50%, they're now targeting 33%. So this is, as best as I can, the hard market explained, how the financial, and this is really an education on how the financial model of the insurance carriers work to affect their pricing. And that's why what you're seeing from many of your insurance carriers is increased costs. With this, we also see a diminished capacity. So where previously carriers had 10, 15, 20, 25 million in abuse and molestation or general liability and excess liability limits available, those limits of insurance are now dramatically diminished. And carriers many times they're going and offering 5 million. Some carriers can offer 10 million in these limits, but the capacity, the insurer's availability to offer this has gone down significantly. All right, so that's the hard market, which is part of understanding that, is part of understanding how you can handle best your insurance in this COVID environment.